A peace treaty sounds like a win. You part on good terms, split assets evenly, and walk away claiming no hard feelings. But what you don't see in the smoke and mirrors of a friendly divorce is the silent erosion of your finances. You think avoiding a courtroom battle saves you money, until the mediator's bill arrives, the financial advisor's invoice shows up, and suddenly that flat fee retainer looks like a bargain that never included the specialist you needed. You assume splitting debts means half your burdens, but the high-interest balances, tax liens, and hidden fees can all land squarely on your plate. You glance at your settlement, pleased with the even split of property and retirement accounts, only to discover at tax time that that neat division triggers penalties and unexpected liabilities. You update your insurance, thinking it'll transition smoothly, then get slammed with doubled premiums and gaps in coverage. And the alimony or support you agreed to as a fair, fixed amount? Inflation quietly cuts its value in half over the years you're writing those checks. If you're breathing easy after a peaceful split, you might be ignoring the very traps that will bleed your bank account dry, one small hit at a time. In the next few minutes, we'll reveal 6 silent financial blows men take after an amicable divorce, so you can spot them now before they drain your future. You thought, well, we aren't fighting, so you'd save a fortune on lawyer fees. But an amicable split often just replaces one set of bills with another, more insidious stack of invoices. The mediator's rate alone can be twice your attorney's hourly fee, and that flat fee, divorce package rarely covers their time. Then there's the financial neutral, an expert you agree to hire who values your assets, business interests, retirement accounts, even collectibles. Their valuation report can run 5 figures, and you'll each split that cost. Add a forensic accountant if there are complex income streams. They don't come cheap, either. Every hour, scrutinizing tax returns and bank statements shows up on your tab. Don't forget the appraiser who determines your home's fair market value, or the actuary who calculates your pension's present-day worth. Each specialist charges for site visits, data analysis, and report drafting. And those line items aren't optional. They're court requirements if you want accurate, defensible numbers. Suddenly, your affordable mediation process looks more like a minor corporate audit. By the time you add up the mediator, the financial neutral, the appraisers, and the accountants, you spent more than you would have on an adversarial divorce that went straight to trial. Because at least in that scenario, you'd skip some of the valuation experts, relying instead on litigation tactics to pressure for settlement. In a friendly divorce, every niche need translates into a separate expert, and every expert has an hourly rate that ticks upward whether you're in meetings, on the phone, or reviewing drafts. Think you can DIY the spreadsheets? Even then, you'll need someone to testify to your numbers if things go south, a CPA or valuation specialist who can't just waive their fee because you're getting along. They're professionals with billing structures of their own, and because these costs often show up late. After you've earmarked your budget for living expenses, you end up scrambling for last-minute funds or dipping into savings earmarked for post-divorce life. The key is to demand upfront clarity. Get a detailed fee schedule for every anticipated expert, negotiate caps where you can, and allocate responsibilities clearly in your mediation agreement. That way, peaceful doesn't become expensive by surprise. Otherwise, you'll look back thinking you saved thousands by not fighting, only to discover you spent even more keeping the process amicable. You thought splitting the debt right down the middle was fair, until the fine print turned half into more than you bargained for. In the rush to divide assets amicably, it's easy to gloss over the details of each liability. Which loan has a variable rate that can spike? Which credit line carries an annual fee that automatically renews? Once you both sign off, you're locked into those obligations. Take the auto loan you each agreed to split 50/50ths. You drive the car most days, but the loan stays in your ex's name and bill goes to you when she misses your turn. Or consider the home equity line of credit. It was tapped for the kids' college fund. Debt you assumed would end once the account was closed. But a missed notification for renewal fees can reopen it, and you find yourself paying interest on a line you thought was retired. Then there are joint credit cards that, despite a settlement, remain in both names. If she decides to stop paying, Those missed payments damage your credit score. And if she carries a balance with high penalty rates, you face late fees you didn't anticipate. Splitting debt isn't just math on paper. It's tracking every due date, every renewal, every variable rate that could surge. Worse, some debts aren't obvious until they bite. Tax liens for unpaid property taxes might slip through the mediation if no one checks county records. Business debts or co-signed loans transfer seamlessly unless you specifically require separate releases. Student loans or medical debts accumulated during the marriage can also get lumped into the general marital debt category, with no distinction on responsibility. To prevent this silent hit, you must demand a detailed debt schedule, creditor names, account numbers, balances, interest terms, and payment histories. Then negotiate clear language. Party A is responsible for creditor X, including all future increases or fees, rather than Party A assumes half of all debts. If variable terms exist, carve out clauses that require notification and reassessment for any rate change or renewal. Remember, debts can outlive marriages. Without airtight provisions, you could be paying someone else's missed obligations for years. An amicable split means nothing if you end up shouldering the worst part of the joint liabilities: one unexpected interest hike, one missed renewal, one unrecognized lien at a time. Transferring assets fairly can backfire at tax time, turning neat splits into messy headaches. You might think swapping the house for the retirement account or dividing investment portfolios equally solves everything on divorce day. But every transfer is a taxable event unless carefully structured, and those capital gains, transfer taxes, or early withdrawal penalties rarely show up until scheduling your accountant appointment. Imagine you let her have the family home while you keep the 401k. Sounds balanced, until the house's basis is outdated and she triggers a capital gains tax when she sells years later. Worse, if you quitclaimed your share without a proper refinance, you could face gift tax implications. On your end, rolling over IRA assets into your name carries required minimum distributions or penalties if mishandled. Even a QDRO, if improperly drafted, can trigger premature withdrawals, meaning 10% penalties plus regular income tax on the entire amount you thought was protected. Then there's the timing trap. Asset transfers in the same tax year can offset deductions or push you into a higher bracket unexpectedly. You sign the settlement in December, and suddenly that lump sum alimony you'd counted on to reduce your taxable income disappears under the new post-2019 rules, leaving you with higher liability and no refund in sight. Or you receive a big inheritance that, under divorce terms, she claims a share, yet its tax basis and timing make your tax bill skyrocket, leaving you responsible for a debt you didn't anticipate. Investment accounts complicate matters further. Transferring taxable brokerage assets without considering unrealized gains can saddle you with tax on gains you never pocketed. If you traded low-basis shares to equalize values, you could owe significant capital gains tax immediately, all because the settlement didn't specify tax-efficient share selection. To avoid this silent hit, demand a pre-settlement tax analysis. Work with a tax professional alongside your attorney, one who can model the after-tax outcomes of every proposed transfer. Insist on language in your agreement disclaiming responsibility for unanticipated tax events, or build in indemnification clauses so each party bears the tax cost of the assets they receive. And schedule all major transfers after tax planning, not before, to ensure you're not inadvertently walking into penalties or liability. A peaceful division on paper can mask a brutal blow when the IRS comes knocking. If you don't map out the tax terrain before you sign, you'll wake up with a settlement that looks fair but feels like a surprise tax bill you can't escape. Insurance isn't just a checkbox in your settlement. It's a lifeline for tomorrow's emergencies, and friendly splits often ignore how drastically premiums and coverage can change. When you separate households, you might think transferring policies to her name or splitting the auto insurance bill is straightforward. But insurance companies see one-person households as higher risk. Rates spike, coverage limits shift, and certain discounts vanish overnight. Take health insurance. You were covered under her employer plan at a group rate. Post-divorce, that coverage ends. COBRA might bridge the gap, but it can cost 2 to 3 times your former premium and only lasts 18 months. After that, you're on the open market, where pre-existing conditions or age-based rate hikes can make a simple monthly plan feel like a luxury. You may need to pay thousands out of pocket for critical medications or specialist visits you never budgeted for. Auto insurance follows a similar script. Carriers often charge more when only one driver is on the policy or when a high-use vehicle suddenly has full responsibility on a single driver's record. If she keeps the kids on your policy for visitation coverage, you could face higher liability premiums or loss of multi-vehicle discounts. And if your policy lapses while you arrange new coverage, you might be penalized for even a short period of non-coverage, leading to surcharges that stick for years. Homeowners insurance is another trap. Removing your name from a deed doesn't remove you from liability if the insurer's records still list you on the policy. Premiums can jump if the dwelling is vacant part-time or used differently, say, as a rental without a proper endorsement. If water damage, theft, or fire strikes, you could find claims denied because the risk profile changed and wasn't updated in your agreement. Even life insurance, which many agree to secure alimony, can fall through the cracks. If your agreement requires her to maintain a policy in your or the children's favor, but you never specify the minimum face value, beneficiary change deadlines, or proof of payment requirements, you have no recourse when the policy lapses or limits get lowered. To avoid these silent hits, hammer out insurance clauses in your settlement. Who keeps which policy, who pays the premiums, how, and when coverage must transfer, and what happens if rates change. Require proof of new policies before finalizing, and build in penalties or support adjustments if coverage gaps occur. Because in a peaceful divorce, it's easy to assume insurance will just move over. But when rates rise and coverage falls short, you'll feel the financial squeeze, and it can take months or years to recover. Dividing your nest egg might feel fair, until you watch decades of compound growth slip away. When you split your retirement accounts amicably, you focus on the balance today. Half of the 401k, half of the IRA. But what you don't see in the moment is the power of time and tax-advantaged growth. Early withdrawals to equalize accounts can trigger penalties and taxes, shrinking not just the principal, but the future earnings on what you just lost. Even with a QDRO stipulated split, your ex's half stays invested, compounding in the market, while your half may sit in cash waiting for the paperwork to clear. That cash doesn't grow. It loses purchasing power to inflation, and every day you're out of the market, you miss out on potential gains. If the market rebounds, your ex's account could outpace yours by thousands or tens of thousands over the next decade. And if you're forced to tap into that half for living expenses, maybe to cover moving costs or a new rental deposit, you trigger early withdrawal penalties, often 10%, plus income taxes on the distribution. That double hit further erodes any immediate cushion. Rebuilding that lost ground isn't as simple as restarting contributions. Your employer matching may be gone. Your salary could be lower. The 50-50 starting point quickly becomes a 60-40 deficit in real terms. Then there's the emotional cost when you check your statement 5 years down the line. You see your ex's balance comfortably climbing, while yours struggles to recover. That disparity can affect your retirement timeline, forcing you to work longer or take riskier investments to catch up. Both stressful prospects you never anticipated when you signed on the dotted line. To guard against this silent hit, negotiate for offsetting assets rather than immediate cash splits, perhaps taking a slightly smaller share of a high-growth account in exchange for other marital property. Or arrange a staged distribution that equals out growth over time, not just balances at divorce. At minimum, run retirement projections pre-settlement to see the long-term effects of any split. Because in a peaceful divorce, it's easy to part with half your savings, and even easier to forget how big half of a growing account can become. You agreed to a fixed alimony or child support amount, thinking stability trumped flexibility, only to watch inflation and cost of living surcharges quietly erode its value. At signing, $2,000 a month in support feels generous and fair. But 2 years down the road, rent has climbed, groceries cost more, and utility bills soar. Without a cost of living adjustment clause, the check you send each month buys less and less, while your own expenses keep climbing. That gradual squeeze isn't dramatic enough to trigger renegotiation under most settlements. Courts view fixed terms as reliable. They're reluctant to reopen agreements just because the economy has shifted. So you end up working harder, cutting back elsewhere, or dipping into savings you'd set aside for your own future, all to maintain what once felt like a comfortable obligation. Even worse, your ex benefits from the silent gain. Their rent stays the same for a year, their mortgage may be on a fixed rate, and they shop in a rising price environment while their support dollars stretch further in relative terms. Inflation acts like an unspoken bonus, lifting their purchasing power while your income stagnates. To prevent this, insist on tying support to a recognized index, like the Consumer Price Index, so that payments adjust automatically each year. If full COLA clauses feel risky, negotiate a partial adjustment, capped at a reasonable percentage. Alternatively, build and review triggers tied to external indicators, such as a regional inflation report or median rent index. Without these guardrails, you'll carry a financial burden that grows lighter for your ex and heavier for you. 1 point of inflation at a time. Divorce may feel like a clean break, but peace often comes with a hidden price tag. You avoided courtroom battles and bitter fights, only to face a cascade of expert fees, surprise invoices, and valuation costs that quietly eclipse what you saved on attorneys. You split debt down the middle, then discovered half the burden can mean all the risk, variable rates, renewal fees, and liens that land squarely in your lap. You traded assets fairly, only to learn at tax time that each transfer can trigger capital gains, gift taxes, or early withdrawal penalties, leaving you scrambling for deductions you never budgeted for. Insurance transitions smoothly in theory, but in practice your premiums skyrocket when policies shift or coverage gaps appear. You divided retirement accounts 50-50, never realizing that compounding growth and early withdrawals can leave you decades behind. And that fixed support amount you deemed fair? Without inflation protection, its bite grows ever smaller, while your living costs climb. None of these hits arrive with a gavel or a fight. They drip in quietly. One appraiser's invoice, one variable rate spike, one missed QDRO detail, one unsupported premium increase, one missing COLA adjustment. By the time you see the impact, the settlement is final, the window for renegotiation closed, and your savings drained. The key isn't turning peace into war. It's spotting these traps before you sign. Demand transparent fee schedules, detailed debt schedules, pre-settlement tax analysis, precise insurance clauses, retirement growth modeling, and COLA-linked support terms. Work with your attorney and financial experts to map out the long game. Because a truly amicable divorce doesn't mean a silent financial surrender. It means crafting a settlement that protects your future as fiercely as you protected your marriage.